Hello, everyone. This is Akshara Menon from PMS Bazaar, welcoming you to another insightful webinar on the topic Early Stage Access to India's Manufacturing Growth Story. Over the last few years, investors have witnessed one of the most dramatic shifts in the global markets. We have moved from era of abundant liquidity and easy money to one where the capital efficiency, profitability, and execution matter the most. India is today witnessing a fascinating convergence of entrepreneurship, technology, and capital. While public markets often capture the headlines, most of the significant value creation stories begin years earlier in private market ecosystem. The question every investor increasingly asking is that where is the next decade's wealth creators come from, and how can investors participate in that journey? Interestingly, many of the biggest wealth creation opportunities in manufacturing are likely to emerge long before these companies become publicly listed. Now that another question is, where is this opportunity today and how can investor identify them early? To help us to understand this evolving landscape, we have with us someone who has spent years in investing exclusively in India's manufacturing infrastructure growth story. Please join me in welcoming Mr. Vignesh Shankar, founder and managing partner at A99 VC. Vignesh Shankar is a seasoned business leader with proven track record in driving growth across multiple industries. Currently, as a founder and managing partner at A99 VC, he leads investment screening, deal structure, and portfolio expansion. Vignesh is a chartered accountant and holds a master's in commerce from University of Madras. Thank you for joining us today, sir. So we'd like to have your PPT. And before that, I just want to give a small disclaimer to all these participants who have joined us today. So put your questions on the box, which will be taken after the PPT. Over to you, sir.
Okay, so first of all, thanks Akshara and thanks to Pallav of PMS Bazaar for having me here. PMS Bazaar is like home. I've lost count the number of times I've done something with them over the last 5 to 6 years. So, and we've always had great audience. So hopefully we'll have a good session now. Kushi, let me know when you're ready to share. So to set the context, right, let me give you a quick background of who we are and what we are doing. I'm Vignesh. I run A99. We are a very industrials focused, manufacturing infrastructure focused fund. We are the third fund now. The fund size is about 1,000 crores, and we largely invest only in the manufacturing industrial space. So let me start off with hitting the first ball out of the park. See, manufacturing, wealth generation has got a lot of opportunities, especially in a place like India. We at A99 firmly believe that wealth generation is a multi-decadal uh, manufacturing is a multi-decadal wealth generation opportunity in India, and we have some solid reasons for that as well, right? To set the macros right, we got to about 4.5 trillion of 3.8 to 4 trillion of GDP on the back of a very strong push from IT and ITES, right? Now, IT and ITES is going through its own rediscovery phase where that kind of growth for the last 20 years, which got us to 3.8 trillion, is really not going to be a real possibility because of AI and also lack of sustained R&D in this space. So if India has to grow, we have a target to be at 35 trillion, right? At least to be, let's say, double from where we are today. We need a couple of other large segments to fire. And that's why if you see the capital outlay to the manufacturing segment or to the infra segment has been huge from the government, and also a lot of private businesses or large conglomerates are investing majorly into it. So to you look at the slide that's in front of it, it's a simple, it's easily understandable slide. Today we are at about 3.8 trillion and we target to go at 35 trillion, right? Today our share of manufacturing is about 532 billion or 50 lakh crores. And we need to get this to at least 8 trillion, which is almost, if I'm right, 16 times from where we are. And the same with infrastructure, it's at 200 billion to go up all the way to 2.5 trillion. So to get this is a bad necessity if we have to even sustain our current growth rates, right? India should ideally rebalance its economic structure by strengthening this, and that's what the government is also looking to do. And in Jan 2026, we hit our highest ever PMI. Okay, and the index is constantly indexed, and you see even the kind of support we are getting in public markets from the manufacture on the manufacturing side of things is amazing. We had Sedamac recently, which has outperformed every other IPO that came along with it or before it. So it's not only a basic necessity that we should grow, but it's also the segment where the green shoots and the growth shoots are firmly visible. Okay, so we all know a bit of history here, right? So we all know that uh, we have always been first an agri-based economy and then finally service-based economy. But it's not that manufacturing didn't grow. You know, if you remember the old ads, Samara Bajaj or Shankar Cement ads, manufacturing has always lived with us throughout. But we really haven't. It's a very boring segment, right? So not much of it's not glamorous as the IT side. So it's been largely a quiet performer. But we are around 16-17% of the total GDP. But we think this is set to be disrupted, and we can see this. I'll show you why also on the upcoming slides. We see this significantly changing, and the government is also aligned to do the same. Okay, so why now, right? Like I said, it's been happening for quite some time now, and why are we giving it special focus now? See, today India has got a few advantages that it's not had together over a past over the past years, right? Government is definitely increasing sustained growth focus on manufacturing and infra. There's a 10 to 12% CAGR that is already factored in all the budgets that are coming in. There are a lot of manufacturing clusters that are getting developed throughout the country. You know, earlier it used to be Chennai, Coimbatore, Nashik, Mumbai, specific pockets. But now you see large Orissa is picking up, Northeast is picking up. Quite a few clusters are coming up. The China+1 is a big focus because I have been personally involved in moving about $5 billion worth of manufacturing opportunity from China into India in my earlier job. And we are also moving up in terms of the ease of doing business and others. And today we have already been a very good exporter of autocoms and others. Now we have cracked defense. I think it's only a matter of time before the other segments also we crack. And we have just manufacturing is not growing. We have the related infrastructure growth also that is coming in. There's almost a $1 trillion outlay all the way up to 2047 in this infrastructure side. So if there is so much of impetus that is coming from the government and markets and the private segment, it's only a matter of time before investors start seeing this. It's not that investors have not been seeing this. There's a slide which I'll show you which shows how manufacturing return good money. But we need focus. We need to break through the monotony and stay invested in this segment. And recently, there is, if you see, there's an RDIF fund that the government has set up, out of which we also will be getting money, which is a huge outlay of $12 billion. It's one of the highest. And you have PLI schemes of almost 30 billion that is coming into the country. So I think we are the right time, and this is the time we start focusing majorly on manufacturing. Now, I just get into the mood while talking about manufacturing. But anyway, so coming back, right? So when we set up our fund two, the idea was not for it to be focused on manufacturing. We thought like every other good fund that is around, we will do multiple segments. But when we saw that in India at any given point of time there are about 10 to 12 good tech deals, right? You take AI, SaaS, whatever. There are about 150 to 200 investors of our kind, that is private equity and venture capital funds, that are chasing these 10, 12 good deals. So two things happen, right? When there are multiple suitors for one opportunity, the value of that opportunity tremendously grows. Whether it's worth it or not, it still grows. It's a market factor, right? So because of which what happens, we end up overpaying for these opportunities. And the second and more and because we overpay, we start pushing the businesses to deliver their higher valuation, and business fall flat. This we saw a lot in the tech space. And also the second thing that we really realized was, see, we all come from a manufacturing and finance background, right? And we know this space reasonably well. Trying to rediscover ourselves in a tech space also was a challenge. So because of these two main reasons, we thought that manufacturing is something we know, but is there an opportunity to invest in that? Okay, so to understand this deeper, we ran a detailed survey where we went to, let's say, the general manager of L&T, general manager of MRF, or general manager of Rockwell Industries, to see if they identify an opportunity which is needed in the market. If they come out and set up a manufacturing business, is equity available to them? So that is one question that we had. And the second part of it was we went to these IITians and other engineering colleges and asked, if you come out with a brilliant idea, which is in manufacturing space, do you get the money to actually put it in? The results that we got were actually quite appalling for the manufacturing segment. It was that all these guys in unison, especially the general managers, said that if I have an idea and if I have to set up something, there are only three sources available to me. One, I put my own money or go to family and friends, or I pledge my house or my wife's jewelry and I raise capital for my this one. So we understood that this segment was not getting enough early stage risk capital. When we went to the IIT side of things, we understood that fintech and other tech areas got ideas funded just on paper napkins and $10 million valuation, 1 million input. Whereas if someone wanted to build a hard asset product out of IITs or out of colleges and get into the business, funding was not available. So we understood that there was a funding imbalance, but we wanted to further look at this with data, right? So if we looked at the total investments that has gone into the VC and PE ecosystem over 10 years, right, from 2013 to 2024, 2013 to 2021, we saw that if 100 rupees went into that overall VCP ecosystem, only an average of 1 rupee or 1 rupee 50 paisa went into these core area of manufacturing and infra. Over the last 2 years, it's picked up. In fact, it's now at almost 28%, which is very good for a segment. But when we were doing our fund two, this was a very appalling number. But coming from an investment banking background, we knew private equity guys give money to manufacturing. So we were very keen on understanding where this money is going, right? So when we saw that, it was all on the Series B, Series C kind of deals. And the pre-Series A to Series B was a whole white vacuum. That's like, Kushi, next slide. So that's the reason we said that, okay, the need of the hour would be a manufacturing and infra focused fund, right? Because of there is a white space in early stage, which I just explained. And that is when the entire deep tech phenomena took over, right? I'm sure many of you who are in this space now have investments in deep tech and all. See, it's a brilliant space, and that's how innovation and rediscovery happens. But when you're in the business of taking people's money and investing and giving money back to them, we as a fund, me and my partner Ganesh, we always thought that we will get into deep tech when the opportunity becomes manufacturable. For example, if somebody is saying that 3D printed rockets or making components for Lyzr can be done through an innovative mechanism, we want to give money when they actually are manufacturing and customers are buying it. Till then, we are only selling hope. That's at least our thesis, right? So, moonshot ideas we will not fund, but we will fund deep tech manufacturing ideas. That is the second learning that we had. The third thing I already touched upon this. IT and ITES sort of plateaued, right? So because of that plateaued, compressed opportunities in IT and ITES, we saw that conventional playbook in infra and manufacturing should pick up. So we wanted to break beyond the mold, which was largely focused on tech investing, and go into manufacturing and infra. The fourth thing is, see, if anyone who understands a manufacturing business will know, money that is given to a manufacturing founder or a manufacturing promoter goes largely towards funding assets, because with those assets and machinery only the production happens, and that's how your revenue comes in. Okay, you take the other side of things, you go into a investment to tech, largely you are funding, largely, I'm not saying everything, but largely goes into funding people's salaries. You need to employ the human capital to generate, to write your code, to do whatever. So if the business fails in case of a manufacturing, I have the recoupability of going after the assets. At least the assets will return some capital I've invested. So there is some stability and resilience in it. Whereas if I go into the tech side of things, right, I'm not going to reach out into other person's pocket and take his salary back. That's never going to happen, right? So we also saw that stability and returns is there. So all this is good. We still have to be able to be in a position to return money to my investors, right? So where is it going to come from? Coming from my investment banking side, I always knew that mergers and acquisitions or strategic acquisitions by MNCs or bigger players was an option. Management buyouts or promoter buyouts were an option. And of course, private equity buyouts was an option. The real clincher for us was when you looked at data, if you see Nifty manufacturing over the course of 5 years has returned an average of 22%. Okay. Nifty infra has returned over the course of 5 years, 23%. Compared to IT and banks, some of the other preferred things, it's a 9 and 13%. So the market is also pricing hard asset businesses that have a tangible product that's coming out in a very good way. And it's if you have a decent management and good management process and efficient delivery, market is giving a good premium. Even take the last 1 year. We all know it's been a certain harakiri in the markets, right? Where a lot of capital is lost. But manufacturing is still holding about 12%, and infra is holding about 13%, whereas the negative returns in the IT and other space. See, I'm not trying to push anybody down, but good tangible businesses where hard assets are in play, the market is pricing them well. Take an example of Sedamac, right? Sedamac is a recent listing where we have been tracking it as a private stage play for a really long time. We couldn't get our money in, but we have been tracking the growth. Motors and controllers and sensors for the engine play, taking on the likes of Bosch and delivering a hard asset business. The market has really come out and saluted even in a horrible market condition. They listed at their upper band was 940 bucks. They listed at 1,400. I think today is 2,500 over 3 months. Phenomenal returns. And if you take the returns that come even prior to listing, it's unbelievable. They are the first $1 billion market cap business from the hard asset manufacturing space. So all this sort of convinced us or gave us the what wherewithal to go behind this big segment where we see tremendous opportunities. Next slide. Okay, so talking about us very quickly, right? So we raised a 105 crore fund along with help from the PMS Bazaar team and others. We have deployed we are 100% deployed as of March 26, 9, but the remaining also is going to be deployed by end of this month, beginning next month. We had a 4-year investment horizon, which we did in only 2 years, and we have a total fund life of 8 years. Currently, we are tracking about 3.05x in terms of MOIC. MOIC is multiple on invested capital. So the 100 crores we have put is worth 300 crores already, and our IRR is current about 75%. We see multiple exits coming over the course of the next few years. I'll just take you through that. So in this fund, the fund two of ours, we allocated up to 8 to 10 crores in every opportunity. That's the maximum check size we did, since we were largely pre-Series A and Series A. Thanks to we went early into this segment, and thanks to that, we were able to see some very good deals that came to us and which we sourced as well. We have done a disruptive motor technology deal where we make motors without any rare earth magnets. So the rare earth is a big theme. We looked at it much earlier. And today we got in at some 125, 130 crore valuation, and currently it's valued around 800 crores with a fantastic order book. They've sold their product to Havels and other customers for giving motors for their mixies, grinders, fans, washing machines, everything. And now going into the automotive side, that's done well for us. We have done in specialty chemicals for the metals and minerals side for bauxite, coal, and iron ore. Better extraction using specialty chemicals. We expect an IPO in 2028 by then. We have done a couple of semicon ideas, which today cooling is a big problem. Heating up is a big problem. We are providing cooling solutions by being on the chip. That business we have invested out of Orissa. We have an analog in-memory compute business called OptoML also, which is currently sought after because of their exceptionally engineered product that they have. We have funded Asia's only high voltage electric OEM, which recently has raised money from a couple of large investors, including the government of Tamil Nadu, doing very well. Non-invested. So like this, we have a plethora of ideas that we have done. We have done a Gen AI for manufacturing and BFSI, which is one of our biggest bagger. We got in at I think around 90, 100 crore valuation. Today it's valued at 6,300 crores. So some very exciting deals that we have done. We have started funding the data center space also. We have invested in a data center rack manufacturer, who we are very excited about. So this special focus on manufacturing and being in the industry and the ability to provide early stage to late stage VC capital to venture capital to these kind of companies has created a good niche for us. And God's grace, we have done well also. Like I said, we are 3x our invested capital already. Okay. So now we decided that manufacturing and infra is still largely undiscovered for us in India, and like I'm going to re-emphasize this, it's a multi-decadal wealth generation opportunity. Now, a small issue that we had with our fund two was this: we were giving check sizes of 8 to 10 crores, which were satisfying the company's needs, the company in which we are putting money's needs for about 15 to 18 months, because manufacturing is a cash guzzler, right? Assets need to come, factories need to come, production needs to happen, sales need to happen. So we were again forced to go and raise money in 18 months. So when we do that, we also had the challenge of giving up our valuations cheaper, because if we waited some more time, the valuation will be higher. But we were restricted by the check size we're giving. So when we decided that we'll do our Fund 3, manufacturing infra fund, we decided we will cut bigger checks, 30 crores to 100 crore kind of checks, with the staying power of, see, if I give a 30 crore to 100 crore check for the first 3 years or 3.5 years, the promoters did not go and raise capital again. They have me to give them money over the course of time. That means my value is also getting built and the promoter is also getting enough time to focus on the business. Having said that, we have since then we decided we'll do a $100 million fund, which is about 1,000 crores in size. I will take you through the details now, but the most important thing about this fund is the thesis. Okay, so let me cover this before going into the thesis. So the fund, it was 850 crores when he started. Today it's 1,000 crores. 70% fresh investments, 30% follow on from earlier fund and from this fund. We move from being a pre-Series A to Series A funder to a growth late stage VC, early stage PE. We go all the way up to Series B rounds, and we have seen very good traction. I'll talk about it in the subsequent slide. It's the same 4-year investment horizon and 8+2 fund life. So this is the slide that I would really like to talk through, because earlier for us, manufacturing could mean anything that is manufactured, right? Movability, markability, and machine was what defined manufacturing for us. The chair that we are all sitting on is also manufactured. The table we use also manufactured. India traditionally has been a build to print kind of manufacturing ecosystem. When I say build to print, what do I mean? You have these MNCs and other design companies who come and give you a design or a bill of material and say, "This is my design, please make it for me." 90% of today's manufacturing is these people running the designs through the factories, through labor and through machines, and giving the output out, for which they get a flat 8% operating margin or 8% profit margin on every product. If you see, manufacturing, generational manufacturing families are all very well off. You know why? Because they let their wealth and their money compound at the 8% profit that these guys were giving them. And 8% over a course of 30 years is phenomenal return, right? So that's why you don't find anyone who has reasonably run a manufacturing business for over 20 years being very in lack of wealth. They all do very well. But is this going to be sustainable for India's future in manufacturing? No. Why? So today, someone is giving machine hour and labor hour rate and building to print at 8%. Tomorrow, I can go in and say, if I can fund the same machines and my cost of capital is less, I can do it at 6%. So the customer's loyalty towards giving you business is largely tuned on price points when you're doing only build to print. So tomorrow, someone comes and gives it 6%, they're happy to move. So your customer stickiness is not there. So we don't want to invest in business like that. So what we want to do is we want to invest in businesses that have a 25 to 30% gross margin and which have established a moat or a stickiness with the customer. Now, when will they do both of it, a high margin and stickiness with the customer? You will do only if you have a underlying IP in your product, or you have done significant R&D that gives you a good lead over your competition. So we will focus as pillar one of our investing largely on IP and R&D driven manufacturing ideas, where the underlying is a broad themed IP and R&D. So it's a very good stat that India is one of the largest generators of IP in the private manufacturing side. But what the challenge also is we are the poorest when it comes to commercializing. When I say commercializing, taking the idea IP into what do you say, to a viable product that can be sold in the market. The good news is our research says that we see this ratio flipping. Basically, we are going to have more commercializing of IP ideas, and we are going to go more towards 25 to 30% gross margin at a product level and sustainable stickiness with the customer. Now, that is pillar one. What is pillar two? Today, there's a capital outlay of almost 30 lakh crores in the Indian manufacturing and infra ecosystem, right? It is spread across 6 to 7 segments: semicon, electronics, solar, shipbuilding, nuclear power generation as such, transmission, etc. Okay. each of these opportunities are very capital intensive. For example, a semicon fab or something to do in the semicon ecosystem is anywhere between half a billion to $1 billion. When I have only 1,000 crore fund, how do I invest these guys? I cannot, right? Because I have a financial restriction. But if you are a manufacturing investor and if you don't play these high growth segments, you're also missing out on an investment opportunity. So that was the quandary that we had when we set up the thesis, right? So to understand each of these segments better, we broke each of these segments into bill of materials. Bill of materials basically is what it takes to make a semicon chip. There we saw there was about 50 to 60 players who have to do bit roles, big roles, small roles, great roles on getting the semicon chip out. So this that is when it struck to us that we need not always go after the large wheel. We can look to invest these multiple small wheels that rotate the larger wheel, like in a watch, like how they rotate. So that is why we said we will go in for these shovels. For example, in shipbuilding, we'll go after ballast filtration. We'll go after electronic propulsion. In nuclear, we will go after ceramic that's go into the SMRs. In semicon, we'll go after gallium purification. We'll go after clean rooms. We'll go after gas exchange. So these multiple small wheels, without which the large wheels cannot sustain, that is what we will invest, and that's what we call the shovel strategy. The third is a no-brainer. Anyone who has gone to a factory floor knows that we are still largely manual and very monotonous in the way we manufacture, right? We have cracked we have cracked automotive exports. We are cracking defense exports, but there are going to be other segments which we need to start exporting to be globally competitive in our this one. For all of that, we need to digitally disrupt our shop floors. Without digitally disrupting shop floors, there is no efficiency that will come into your cost, right? All the MNCs want to acquire all foreigners. The days of we sending people at $1,000 per hour rate and paying the individual 150 and making 850 margin, which the IT services companies used to do, is gone. Today, every product also, every year you manufacture product, the consumer or the your customer wants you to give back 2% cost down every year. If you have to have operate in this scenario, compete with the likes of China and Vietnam and everybody, Korea, who are competing with you, you need to build efficiency in your shop floor. That will come only if you digitally disrupt shop floors. That could mean robotics, that could mean analytics, that could mean IoT. Industry 4.0 and 5.0 is a no-brainer which will invest. Originally, our idea was to do only three pillars, right? And we have been fundraising for our new fund since March 2026. All the investors asked, AI में क्या कर रहे हो? What are you doing in AI? AI ல என்ன பண்றீங்க? Okay, so as a manufacturing infra focused fund, my idea was AI investors know their AI business, they will do it. We will do this. But when the market from whom we are expecting to raise money is consistently on this, we reached a point where we thought that we will not do AI, but we need to tell it to them in a way that resonates with them. So we went through how AI works, we did some research and all. AI, we understood, is largely restricted not by its ability to compute faster or its hallucination or its disruption that happens every week with different versions. The biggest restriction for AI is the physical layer. When I talk about the physical layer, what do I mean? See, only if you have data centers, cooling, power supply, compute power, hard drives, AI is even able to function. So without this physical layer, there is no AI that can be computed continuously, right? That is why today you see in SpaceX's IPO, I mean the prospectus that they have filed, they're talking about how SpaceX looks to leverage this AI data center physical requirement by taking stuff to space. Okay, that is Elon Musk, he can do it. But in a place like India, you need to have a physical layer before AI actually computes. Sarvam is getting built on its own. That is very good. Sarvam AI, India's attempt to build its own LLM is very good. But even that is restricted by the underlying physical infra. So we decided anything that is in the physical infra layer of AI is a point of interest for us. And there is no AI without hardware. So we'll back the hardware. So largely our thesis will go around this. So talking macro is the easiest thing that all of us can do, including me, right? So we are all at the macro level everywhere. So ये करेंगे ये ऊपर से ये देखेंगे this is what they have to do, this is how Sachin has to bat, this is how we have everything ready. But going down micro and doing the job is where the real challenge is. So what we did, we identified growth segments that are above 8% in the manufacturing segment in India. And we applied our macro thesis to each of it: IP, R&D driven manufacturing, the shovel, Industry 4.0, and of course, the physical layer is different by itself. So we identified significantly I wouldn't say minute, but more micro level ideas that we saw. So all the blue dots that you see on the screen is all deal pipeline that we already built in. So we applied IP, shovel, industry semicon. We found a design IP opportunity. We found a high purity chemical and deep deposition tool opportunity. So like this, we have gone micro into each segments, and we'll continue to do this to ideate. So that's how we translate the macro into micro. So this is only for the audience that we have here, and we have not given out any names. So largely, our deal pipeline is going to be around these opportunities, right? We are looking at a power electronics opportunity. We're looking at data center infrastructure. We are looking at nanotech membranes for both green hydrogen and other energy storage forms. We are looking at zinc air batteries, green metals and rare earth extraction out of India. Someone who's building defense data subsystems. So the opportunities, once we have a clear thesis, is very, what do you say? Very lucrative, and it's also very positive for someone who has a thesis like us to come out and say this. So we have a deal pipeline for about 200 crores for the next fund, and recently we had our IC some just a couple of weeks ago where we got approval for about 165 crores. So we are with the money and we are with the ideas to further invest in these segments. So where are we as a fund? Our target is to be 1,000 crore fully committed fund. We started the fundraising on March 26, 2026. Today is June 5th. So in the last April, May, the last 60, 70 days, we have done our first close at 170 crores. We plan to close this month with a 500 crore commitment. We are already in talks to close this with some large investors. And by Diwali, we want to completely close this 1,000 crore fund. I think the opportunity is now, and that's why we could have taken our time to stretch it over 2 years to raise this money. The opportunity is now, and we don't want to miss early triggers like how we missed with Sedamax. So we have some very good ideas where we want to park money. That's why we are really trailblazing and raising this kind of money. Uh, 60 days to raise 200 crores is no mean feat. So thanks to my team and others and my investors from Fund II who also backed us, and incoming new investors. So we are at a good place in terms of fundraise. So how did we arrive at this deal pipeline is an interesting question, right? So we use a combination of human intelligence and artificial intelligence. So we have a universe of about 30 lakh companies in the Indian MCA database. We segregate them, we remove the unlisted and operational ones, and then which are the companies which are focusing on manufacturing infra, which is our universe, is about 5.4 lakhs. And then we don't do zero revenue deals unless it's very good. So we had a 25 crore revenue cutoff, which brought it down to 34,000. And then which has a high growth rate, like I told you, over 25 to 30% gross margin, 15% EBITDA margin. It's about 6,893. And then within our thesis, what works? So we have a universe of 5,570 companies that we can actually look at. From this 5,570, we have picked only 8 ideas so far, which have been approved by the IP. We have rejected multiple. So this kind of application of artificial intelligence and our own outbound is giving us some very good deals. We generally don't depend on the investment bankers and others to show us deals. We largely do this through our own outbound outreach, which has so far been very successful for us as well. Okay, so in terms of team, I'm a chartered accountant. I come with about over 20 years of experience in this space. I ran Stanley Black& Decker both in India and Asia as their CEO, managing a $500 million P&L. Ganesh, my partner, finished CA with me. He's been a thorough investment banker with exposure to manufacturing through his stint at Sanmar Engineering and the Ambassador Group. Asha is also our partner. She comes with focused investment banking experience from Spark Capital and others. So she leads the investments along with Prem, who's a principal investment. He comes with manufacturing experience in the Murugappa Group and also with me in Stanley Black& Decker. We have a special team called Portfolio Enablement that's headed by Anirudh. So largely the idea is just giving money and expecting them to perform is actually quite unfair. So Anirudh and his team spends time with each of our portfolio companies in helping them out with opening doors, getting them sales deals, helping them hire a CFO, helping them raise money. So a portfolio enablement end to end. So that is what we as a core team, we have another set of very bright 5 or 6 people in our team below all of us. What we are really proud of and we think is a blessing from God is the other side, which are more advisors, right? So we have Mr. N. Kumar, who's past president of CII, on the board of multiple listed large conglomerates. So he's the chairman of our IC, chairman of our business, and he keeps us really grounded. We have other gentleman, Bala, who's also on our IC. He just sold his large fixed income business. He comes with a tremendous 30 years of banking and markets experience. And we have some subject matter experts. Mr. Sunil Deshmukh is from Goodyear Tires with manufacturing experience. Mr. Gopal was my boss in Stanley Black& and Decker. Thorough end-to-end manufacturing gentleman. Satish comes with a lot of EV experience. So though we get excited with a lot of the deals that we do, these are the gentlemen who really keep our grounded, and we get a lot of market intelligence through these people. So very proud of who we have as our advisors. Yeah, so that's all. That's all I had. I think I overshot the time. Sorry, Akshara. So sometimes I get excited. We keep this quick. So if you have anything, please write to us. PMS Bazaar is our only partner. So anything you want to understand about our fund, please reach out to them as well. Thank you.
Thank you, sir. That was a wonderful PPT. You walked us through the investment philosophy, portfolio construction, and where do you see opportunity emerging. I think that
Mhm.
was a, you have not crossed the timeline because, we have just started up 5 minutes late. So I
Okay.
think you're always on time. So there
Thank
was no
you.
delay in
Mm.
it.
Thank you.
So coming back to that, I would like to know where are investors at now. And I want to ask few questions from an investor's front. Yeah.
Sure.
Let
Sure.
me start off with a bigger picture. Of
Mhm.
course, how the PPT started about, about India receiving the thing. So, of course, India is receiving a lot of attention for a long term growth story. Yeah.
Mhm.
But how much of this India narrative today, is probably run by the fundamentals, and how much is from this China+1 opportunity?
It's a good question. See, I'll tell you, India is all about fundamentals, right? So, though our markets are not showing that and all, see, I think it's momentary. You show me a country which is consistently growing at 6 to 10% GDP, which has got the youngest population in the world, which is now just today they rejigged this FII dollar and other fund working on tax reforms, has been having a stable government over 15, 16 years, and where manufacturing has been underserved so far and now real impetus is coming into it. And I I think it's nothing but fundamentals in our case. Yeah, of course there will be short term blips. There is red tapeism. There are issues that we have, and which country does not have? There's nothing. There's no country which does not have issues, right? So fundamentally, it's very strong, and I think all bad news is getting factored immediately, and immediate action is getting taken. So I think fundamentally, it's very strong. Okay, China+1. Let me tell you one thing. We should never try to be China. Okay, that is my firm belief because we are running a race of 30 kilometers, for example, where we started when they were at 25 kilometers. Okay, we started the race only when we are 25 years behind them, to be very practical.
Okay.
And today, if let's say the building in which I'm sitting is earmarked as a factory spot in China, tomorrow this spot will disappear. Okay, and a factory will be there. You can never do that in India. So comparing these two kind of things is very difficult, right? Here we need policy, we are a democracy, a lot of things move slowly. China+1 is good, where there is global frustration on protective or preventive practices of China and they want to move it outside. For example, now ASML has signed its first, what do you say, semiconductor alignment deal with the Tatas. Okay, the Prime Minister was also part of it. It has never done it before in its history. It has done it now because it doesn't want to keep all its eggs or whatever in China. Same with Apple, where we find it the situation was getting not good between the two. They moved major production here. China+1 also means that China was very cheap and affordable now. Now they have come to a level where India also is affordable. Indians speak a lot more English than Chinese. So I think China+1 is a good strategy. But to take on and completely fight China and all, I don't think we should do it. We should just build on our capability and go ahead. That's what I would say.
Okay, because you spoke so much on manufacturing and infra. So I just want to take this one example
Sure.
because I was so convinced that about manufacturing infra over FMCG and IT now with your
Okay.
PPT. Very
Okay.
honest.
Okay.
So, but
Good.
in times like COVID, I'm
Mm.
telling you, for times like COVID, manufacturing had the biggest hit. Correct.
Okay.
So
Okay.
we can't determine the future. So we can have such situation in the future also. So
Mm.
in that front, how do you think the manufacturing would work?
See, COVID hit everybody. It didn't hit manufacturing alone, right? So I had AI businesses, SaaS businesses, which were quoting 100 million valuations, were ready to sell at 20 million. That's one of the reasons we set up Fund One during COVID, because we wanted to capture the opportunities, right? So I don't know if manufacturing alone will be hit. Okay, but you'll tell you one thing. I was running about 41 plants during COVID, manufacturing plants across 6 countries during that time. You will not believe the kind of spirit these my factory, my operations team, and all had. They all wore double masks, stayed over in factories not to spread, and still do. The spirit of manufacturing can never be defeated by something like COVID. You can see the maximum growth in stocks, manufacturing stocks, has started since COVID. I can give you an example. You take for example, okay, CG Power was a turnaround, but it happened during peak COVID. Okay, the kind of impetus, you can read the book that is there written about the great revival about CG Power, where during COVID, factory workers and general managers and everybody locked themselves in the factory and just built their own ecosystem with a doctor. So from the spirit side, nothing can defeat. But from the practical side, everybody will be hit if there's an act of God. So manufacturing is not very unique, and you can control a lot of things better with manufacturing. You can slow down on your production, cut down costs. All that is possible. You cannot stop paying salaries in the tech space, right? Because it's COVID, which did happen, but the more ideal thing is in manufacturing. So I don't think it's be too much of an issue.
So with everything is getting hit, and I mean, what my question was like, even manufacturing also got it hit. So that is one thing.
When
So
there's an
if
act of God, everybody gets hit. So manufacturing also got it. There's no insulation, right?
yeah, that's fine. So, sir, if I want to ask you one question, if a
Mm-hmm.
founder came up to you, yeah, with a phenomenal growth story, but with an aggressive valuation, so what is going to matter for you today? Is it the growth or the price?
Mm-hmm. I think, see, my segment, I can talk only about my segment. Manufacturing and infra is still not reached the craziness of the tech side. Okay. So that way, I can tell you that so far, at least, that is today, is June 5th, 2026, valuations are reasonable. They are getting tougher. Valuations are reasonable. So if a founder comes to me with exceptional growth and is pricing it in his valuation, I'm okay giving it to him. Okay.
Oh,
In manufacturing. Okay. But other segments, I cannot talk about it. But it is still manageable in our segments. Okay. Okay.
so it's like
And
the
one more
growth.
thing, let me add.
Yeah.
Founders are more realistic in this space because they go through the grind. They are not sitting in air conditioned offices and coding. Okay. They go through the grind. So they know every rupee given, every rupee taken has value. So because of which they are reasonable. Hopefully, the big boys who are coming into this won't spoil it for us. That's what we can say.
Okay, I think that mattered what actually the question is.
Mm,
So one more question that I want to ask you is that in public markets, investors can see the PE ratios and
mm,
earnings,
mm.
everything. Yeah, but in venture investing, information is naturally limited.
Correct.
So how should how should an investor protect overpaying for something which is in the future potential?
Okay, good question. See, illiquidity and lack of data is one of the features of alternate investments, right? So that
Yeah.
is always a given. See, I'll tell you one thing. We do not, okay, my fund, for example, right? We have four various levels of diligence that we do before we take it even to the IC. Of course, financial diligence is a no-brainer. Everyone looks at numbers and we get one of the big four or a reputed firm to look at it. uh, Commercial diligence. So we sit with customers to understand whether they're adding value through their products. My target company is adding value through the products. They connect us to everybody. We go visit the plant where the product is used. That is one thing. Then we have, of course, legal diligence, which is again a no-brainer. But we do something also called forensic diligence, right? So where promoters, okay, they are good guys, but we still want to establish ourselves that they have a propensity to return money. Okay, so we look at their credit card record, we look at their this one. So it is four levels that they have to clear before this comes even. Let me tell you, even in stock markets, right? No one does four levels of analysis before. They maybe people may be doing, but this kind of focused four-level diligence happens here. And in manufacturing, data is more crunchable because if a product is shipped out of your gate only, you can have revenue. That is the accounting rule. You cannot sell hope here. You have to sell products here. So, that way it is more diligence. I mean, I don't know if there's a word called diligenceable. More diligence is possible. And I think nowadays getting data for private markets also is getting slightly better. So,
Actually, very true, to be very honest. But in public markets, what happens is that AI has made us work a little more easier, to be very
Hmm.
honest. Even to research
Hmm.
one stock, AI
Okay.
has made it even more easier. That is
No,
what I
but
just,
the underlying is the data the company gives you, right? See,
yeah.
AI takes what data? What the company gives you only. What if there's some issue in it? Does AI know how to see the issue? No, you still have to train it to see in a certain way, right? So that same thing is possible with our segment also, where we get data, we can train AI to do what it has to do. I don't think AI is making or breaking anything. You do have a pattern of data with public markets, which you may not have here. But 3 years of past and 5 years of forward generally is good enough for us to look at it.
Okay, I think I'll completely agree with your point.
Okay.
But I'll just add one thing. Of course, the data which is limited in terms of private markets. But
Hmm.
in nowadays, like in last
Hmm.
1 2 years, what we are seeing is that whenever those investments are made in a fund, it is always into public. So investors are knowing, most of we're knowing that Acha, this fund has got invested in so and so company. So
Okay.
these limited information is available.
Okay.
But what matters is that exit, because exit matters the returns. So
Correct.
how is your fund seeing that exit part?
Okay. See, our fund one is since exited and returned money, okay, at 7 times, but it was a smaller fund. Fund two, right? Like I was explaining in my thesis slide also, for manufacturing, the market really works well. Okay. Now we have this year, we have about two exits that we are already planned. One of it is a listing, and one of it is a strategic exit, which we have already sort of planned out. If you are willing to wait the 4 year to 6 year course, a good exit is always a possibility, provided the underlying fundamental thesis is good. Okay, that is the thumb rule that you'll find in every venture book that you read about how to select venture capital, right? Now, exits, we get into a business thinking about exits only. Okay, so this concept of when people say go invest and stay long, you sell only when you need money doesn't work with this. We go in looking at exits. Okay, so an exit perspective is built in the day one that we invest. So whether it comes to fruition or whether we actually go, depending on the performance of the business, I agree. But we always have an exit perspective, and that's why we are always focused on. See, we closed our fund two, we did our fund one exit in 2.5 years into it. Why? When we drafted the documentation, we put in a term saying once this business we are putting money in hits a specific EBITDA multiple, you can the trigger exit triggers itself. Okay, so that's why we were able to exit. So exit is a factor that we consider from day one. It's there in our documentation and it's there in our thoughts throughout. In fact, with my team, with the partners and principals, we have a pulse call which talks about exit every day. It's not every day or every alternate day. So it's something that's always in our mind because that's where we also make money, right? So we are always focused on exits that way.
I'll ask one more question on the exit, because
Hmm.
when you say that when the exit trigger takes in
Hmm.
and you'll exit, is there
Hmm.
any company or any deal that you've exited, but
Hmm.
probably after exiting you would have thought, Acha, I should have exited now, I should have waited even more?
That happens only in public markets for me, not in private markets, where I've exited and then my so the trigger for any stock to go up is if I sell. If I sell, next it will start going up. So if someone wants to make money, follow what I'm selling, it's going to go up. So see, in public markets that has happened a lot. See, in private markets, a very informed decision. It's a laborious process, right? It's not that I go today, look at the counter and say click exit. Doesn't happen like that. It has to agree valuation, documentation, diligence. So no regrets. Once you exit, you're happy. That's it.
Okay, I think I was clearly. I can really resonate with you in public markets. I
Yeah.
think I have done the same thing.
Yeah,
So I'll
yeah.
like take
It's for
few
everybody.
questions.
Yeah, sure,
I'll
sure,
take
sure.
few questions from the audience.
Hmm.
First thing with Naveen is that it was great to hear talk about the entry criteria and opportunity. Please elaborate about the exit plan, which you've already done. Perhaps
Mm.
you could take one or two examples from a fund one or fund two.
Examples for my fund one, fund two. See, fund two is actually, I cannot disclose much. Without giving names, I will tell you. See, we have an opportunity today, actually, thanks to the boom in manufacturing and the interest that is there. Today, we have an offer for most of our investee companies to exit. Okay. Fund one, I gave an example of how we triggered the exit with our entry clause itself. They hit the EBITDA number and we exited that business. It's a company called, I shouldn't give names, but it's a business we put money in digital transformation in Fund one. We exited that. In Fund two, so we have a plan now. So, for example, this year we have two exits that I already told you about. In 28, prior to the 29, this one, we have about two IPOs already planned for which the draft prospectus and other things are already happening. So examples I could tell you is where a company is sticking to its plan of execution and it's going ahead, we always start planning exits in advance. So that's all we can talk in this forum now. But any specifics once we have an exit, I can always take it out in private.
Okay, I think some questions, I got to see a lot of questions following the podium, but
Hmm.
these can be taken a bit offline also.
Okay.
So I'll take the next question from Basan.
Hmm.
Thank you for presenting an excellent view on manufacturing. I really
Okay.
loved it.
Okay.
When you
Thank
mention
you.
about having assets versus salary, when
Hmm.
uh, when funding manufacturing versus SaaS companies, it
Hmm.
cuts both ways. The marginal cost of scaling is minimal. Once you
Hmm.
have the software product, so the hockey stick growth is high.
Growth will come in. Okay. Hmm.
In manufacturing, it takes longer time, but there is a
Correct.
high chance of success, and most is big. It might reduce the IRR.
Hmm.
This is once a perception many VCs have. They
Okay.
think that the exit of PE and VC hybrid in terms of multiples.
Hmm.
I'm a big believer of manufacturing and would love to hear your perspective on this.
Okay. See, okay, good question. So there's something called power law in venture investing, right? I think most of us know. They say that one or two investments in your portfolio will give you a return for your entire fund. So let's say 15 companies you invest, 10 companies you invest, two are expected to return capital and give you a massive return. Three are expected to give middling into low returns. Two will return to that, and three will fail, if I got the number right. Okay. So that is the SaaS hockey stick he spoke about comes under that perspective where a couple of companies that he's talking about where SaaS gets factored in will give this massive returns now. See, we are talking about out of 10 companies, we want three exceptional performers, three good performers, and two average performers, and two returning principal for the 10. That is what we can aim and hope to aspire with the manufacturing fund because there's more certainty to what we do, and it is a structured process of doing things. In SaaS and tech, right? You are also sometimes praying and praying. So you don't know how the outcome will be. Okay, at least as an investor, I struggle to figure that out in tech. You don't know. So some of this is more a factor of how good the promoter is, how good the opportunity is, how the selling skill is, and all that. In manufacturing, product the customer says, "I want it for this purpose." The match is already there. Okay, so even though it is a little bit time consuming and boring, the chances of success are slightly, shouldn't say slightly, a little better than what you'll find in a SaaS side. So I think his question was that this hockey stick kicks in SaaS, and it's slower in manufacturing. So how do you look at this? So my answer
Yeah.
is, I'm more tuned to giving returns in manufacturing because of the same process where I don't need hockey stick. I need sustained growth. I hope I answered this question.
Yeah, in your perspective, is was your question? I think that you've
Mhm.
answered it. So probably a follow-up question on it, because when
Mhm.
you said out of 10, two investments can give the exceptional IRR.
Returns.
So looking back to your the journey for
Uh-huh.
the past two funds,
Uh-huh.
so what do you think has contributed to this IRR? Is it like identifying the perfect winners or avoiding that losers?
See, there is nothing called perfect winner or loser. Okay. So one
Okay.
year I'll give you an example of a company. I don't want to give my name, it's my portfolio. I am very bullish. I think that will be my biggest winner. Okay, that's a business. Okay, it's for you to figure it out. Okay. But over the last 2 years, their revenue growth has been flattish to slightly better. Like they go 15%, 12% like that. But I expect it to be a 50 bagger for me. Okay, so
Mm-mm.
as of now, in my teams and my reading, that is a loser. Okay, there's another business where we put very small capital, which is now 90 times from where we have expected. We allocated greater capital thinking so to answer your question, right? This is changes very quickly. Tomorrow, that business which is now providing very flat can outperform in 2 3 years and really set the tune. And this could be a part of a great growth story where the valuation getting built and suddenly something goes wrong. So there is no certainty in this. So I don't see any investment as winners or losers. All are equal opportunity players, and whoever is able to execute it better will win.
Okay. But this question is something which is on your personal front. Okay.
Hmm.
If you were to investing your entire net worth today What percentage would you allocate for this venture capital?
So today, to answer your question, all my money is in my fund. Okay.
Okay.
So my commitment is to the fund. All my money is here. And of course, some I have in the equity markets. So from my perspective, it is almost 80-90%. All liquid money that I have is here. Okay.
Okay.
But in a general portfolio construct side, they say 20% should be for risk capital. Okay. So venture capital is risk capital. Okay. So 20% of your portfolio should be allocated to PEVC kind of opportunities.
Got it. This question you've already answered a bit in your PPT, but if you could
Mm-hmm.
elaborate on it, A99 VC focuses on this, pre-series A to series A
Series
stage,
B. Series
a
B.
series B stage.
Mm.
So, where manufacturing startups are often struggle to attract this institutional capital. Yeah.
Mm.
So,
Correct.
what makes a stage very attractive? Of course, you've answered a bit while doing a PPT, but if you want to add on a few points to it.
See, the macro is demanding this. Okay. You need a lot more innovative and high margin manufacturing to come in. So today, if you remember, when this dollar, just not remember, just a month ago, when the dollar went to 96, 97 and all that, the reason one of our chief economic CEA gave was that our manufacturing game is not up good enough for us to export. Okay. So the macros need it. The macros need it. That's why outlay is coming and that's why people are building. So it's a no-brainer. The second part is why we think it is going to be. That's the question, right? Why we think it is. One, we know only this. So that is one straight face answer. And two is that we can see I ran manufacturing for 5 years of my life across
Hmm.
Asia. So the kind of energy that is there in terms of policy, in terms of innovation, in terms of getting stuff done in the manufacturing space is completely different over the last decade. So it's on quadra jets, if you ask me. So the growth and what is going to come in and see. Tier 2, Tier 3 is firing in a big way in manufacturing. We have 4 investments in Orissa. Okay. We'll go to Coimbatore, Nashik, everywhere. So the glam capitals, the entire early stage, late stage VC ecosystem was largely in Mumbai, Bangalore, Gurgaon, maybe Chennai kind of things. Now, Orissa, Nashik, Bhopal, Lucknow, Uttar Pradesh. So all of them have fund of funds while enabling manufacturing also. The kind of growth that is coming together and it's a necessity, right? Today we are in a world where everything is siloed. Every country is siloed. So tomorrow they can turn the tap off. That's why we believe import substitution backed manufacturing also is a big opportunity. So it's a necessity of time and it's a multi-decadal wealth generation opportunity. So why not?
I think that was very well answered, sir. And of course, clock is ticking. It's almost a hour since we started the
Oh,
webinar.
okay.
So, of course, time just ran very soon. And of course, I could see a lot of questions on the podium on about your fund, about your IRR, about the fees. So these questions will be taken offline. Of course, we at PMS
PMS
Bazaar.
Bazaar. Yeah.
So we
PMS
we will
Bazaar
answer.
is see, okay, generally we don't partner, we don't distribute. PMS Bazaar is more like family for us. So they have been kind enough to look at our fund as well. So please talk to them. They know more. They know as much as me. So
So we'll take those questions. So all your questions will be answered
okay,
through mail or through call.
okay.
So to end it up, like before I could end this thing, I just want to know one
Mm-hmm.
last question. If
Uh-huh.
we're having this conversation again in
Uh,
2035, yeah, like 10 years from now, so what would happen for you is to say that India's manufacturing revolution has truly succeeded?
if India is manufacturing, see, first of all, we will not be talking about China+1 10 years from now, if it really succeeded. That is one good thing. We will not see them as competition. We'll see as someone who's along with us. That is one thing. Second thing, I think cutting edge products or highly innovative products I think manufactured in India. So today, if you know for semicon ecosystem, let's forget semicon also. For data centers itself, racks 95% comes from outside. Okay. Fasteners, I used to run fasteners. You have about $10 billion imported. It's a nut and a bolt. 10 billion is imported. Okay. Welding systems come from outside. So anything that is technology, application happens here, whereas it's getting built outside. So if there's a reverse where 10 years down the line it's built here, and I'm able to back it when it's getting built here, that's the best scenario we can have, and hopefully I will be little more money enabled also if it works out well. So that's the. So
Also, a little more older, of course, because the years are
I'm
going.
already old. I don't think I can get older. So
Not really.
you know.
Not really. Okay, I
So
think that's the experience.
yeah, I know.
Uh, Thank you, sir. Thank you for sharing the lot of insights and your framework about your perspective where the opportunities were emerging in the upcoming years. Thank you very much for your time, and thank you everyone
Thanks.
who have joined us today. We hope the discussion was helped you to understand not just about the fund, but also about the broader market and about the venture capital landscape and the role which is going to play in diversified portfolio. So, thank you everyone. Have a good day.
Thank you. Thank you. And thanks, Akshara. Thanks to the PMS Bazaar team. Thank you.
Thank you.